It's a new year, which means new market themes. We ended last year with lessons learned from the markets in 2024. Thank you for your support and trusting us to educate and inform you on this investing education journey. We talked about the bond markets, the Fed. We were beginner, even got super advanced with gamma squeezes and understanding the yield curve. So many market mechanics.
It's our 70th episode, so thanks to those of you who have been here with us since the very beginning. And to anyone who has just joined, we have a ton of great episodes, expertly titled, if I may say so, for you to get all your foundational knowledge. But today we're discussing 2025 market themes, so it's still a great place to start, and I will do my best to keep Jess out of financial jargon land.
Oh yeah, today's episode is probably going to be a bit jargony, but I'll try my best. We will break down 4 key themes for our self-directed investors today. We're going to start with infrastructure investments, talk a little bit about tariffs, deregulation that could be driving capital expenditure, shifts that we see in retail trading. It's not just buzzwords, but these are trends that are underpinned by real money, real policies, and real opportunities.
Okay, well, that sounds like it's going to be a packed episode, so let's just go ahead and get into it.
Ding, ding, ding.
You're listening to MakeHer, the investing education podcast with a mission to empower you with factual financial literacy to make you finfluent, not finfluenced.
That's right. We demystify complex financial topics in a fun way from her perspective. Get it? Market, make her. We're your host. I'm Jessica Enskip, here to share my 15 years of finance and investing experience to help you navigate the market and make informed decisions with confidence. You can watch me sharing my market insights on Schwab Network, Yahoo Finance, Fox Business, and CNBC.
And I'm Jessie Denouy, your co-ghost with the most, asking all the questions you mortals might be too shy to ask. Just kidding. I'm here to learn how to make my money make money and keep Jess out of financial jargon land so that we can all learn together.
I like the new title, though. Let's keep that.
Ghost with the boast. Okay, so Jess, in 2023, big tech optimized for AI. In 2024, we saw broader market participation and a Fed easing cycle, which we will talk about, I'm sure. Every year seems to have its buzzwords. And you said earlier it's not just about buzzwords. So what are you seeing in the crystal ball for 2025? Is it all about infrastructure and AI, perhaps?
Yeah, so we're talking about what's shaping up to be a monumental year or setup in the stock market. Think infrastructure, innovation, and big investments. This is the year where efficiency meets action.
Okay, well then let's start with infrastructure and what that means for the markets this year.
So infrastructure, it's the backbone of any economy, but in the US, it's overdue for an overhaul. 80% of our infrastructure is government owned, which means the other 20% is owned by private corporations, which means to modernize that, we have these fiscal headwinds. We have a high deficit. There's an opportunity for more private equity involvement to make it more efficiency, to modernize that infrastructure.
Okay, what does modernizing infrastructure mean? Are we talking about like fixing potholes or something more futuristic?
So it's definitely both. So think about traditional infrastructure. We've got roads, bridges, energy grids. It's all part of this picture. But when we're talking about modern sectors like the digital network, AI data centers, and even waste management solutions, because that's something we've talked about quite a bit, is headwinds within AI. They're using all of this energy. Their AI is increasing 10x. There's this need for data centers.
Wait, like AI data centers, like where all those ChatGPT servers live?
Yeah, exactly. Yeah. So companies like the hyperscalers, Microsoft, Google, Amazon, they're spending billions in AI infrastructure. In 2023, it was 230 billion. I think it's over 400 billion now. So the number could get even higher. Remember, we were talking about earnings with AI. Their forward-looking guidance wasn't as good as anticipated because they were still spending, and their spending, part of that spending is on this data expansion because they need that in order to keep going and growing.
Okay, yeah, that's a lot of money, but that's right. I do remember that. That's like all coming together now. So, what can self-directed investors like us start thinking about in terms of our portfolios? Like, if we already have index funds that mirror the S&P 500 in our portfolios, then we'd already be investing in those hyperscalers you just mentioned. But would there be other stocks to research to like maybe diversify our portfolios a bit more, perhaps?
This is where we introduce our investing thesis. And when we're adding stocks to our portfolio as well, know that I would expect you to be on a second layer. So we should definitely link to that episode of the order of events of investing. You want to have a good nest egg before we start adding alpha, which just means stocks. Optimize your portfolio with more stocks. So we don't want over concentration. But you could look at firms like BlackRock. BlackRock, I know there's controversy around it, but it's an investment firm at the end of the day. Always is a partnership with a company called GIP, and they're leading the charge in infrastructure asset management. So it's like taking private equity capital that's very strategic, difficult to access, and trying to find a way through a public company. Kind of like when we utilize an ETF for a broader investment theme, we do that because we don't know what the exact beneficiary is going to be. This is kind of a play like that. But it's BlackRock, for example. They are working with this company that is looking at private equity, that's targeting energy, transportation, and bringing the update to infrastructure on more of a global scale, so not just domestically, and updating that outdated infrastructure that is going to be an issue. Already is.
You know, I didn't even think like you could buy BlackRock stock. Duh. Like, I don't know why I didn't think about that sooner. Like BlackRock, and like, you know, there's always these conspiracy theories about how much like BlackRock and Vanguard own and all these other companies, like how much stock they have, but like we can also own stock in BlackRock. So
and you'll have voting shares too. So don't forget that.
If you have stock, you have voting rights. So, you know, that's one way to think about those things for those of you who like to share those conspiracy videos with me all the time. Anyway, okay, and don't forget, like just mentioned, you do your homework before buying stocks as always, and we do have several episodes teaching you how stocks are valuated, what PE ratio is, how to analyze a stock. So much great information. And if you watch the video version on Spotify or YouTube, you can see when we actually do screen shares at brokerage firms, and just literally shows you which buttons to push. So very valuable information.
So much information. If you're just new here, we get so many comments that say, I wish I would have started from the beginning. So do know that. I think that's important. But let's move on to tariffs next, because it's actually related to everything.
Imagine that.
I know. We briefly talked about it on episode 63 about what's happening with the tariffs, but now we're looking at it with a Fed easing cycle, and that's really important right now.
Yes. Good old Papa Powell, aka Fed Chairman Jerome Powell, who has been a hawkish Fed until pretty recently. So, okay, tariffs. That word gives me 2018 flashbacks. Didn't tariffs like tank the market back in 2018?
They did. So in 2018, tariffs were a key in Trump 1.0 administration as a bartering mechanism. We did that deep dive study. When tariffs were introduced, or there was just talk of them, the market didn't care. It was still rallying. But when the actual policies were put into play, the market went down from peak to trough about 18.5%. Oh, wow. But at that time, the Fed was in a restrictive cycle, which means the Fed was raising interest rates. They're not in a restrictive cycle right now. That's why it's a different story right now.
But so how is it different now that I guess we have a dovish Fed or an easing cycle?
Well, because if we have a restrictive Fed, that is putting strains on the consumer already. Tariffs also put strains on the consumer. If we're easing interest rates instead of raising them, it creates a cushion for the market, because the market is just a bunch of companies. When we say the market, we're talking about the S&P 500 generally. They recognize revenue as long as consumers are spending. If you are putting consumers in a difficult situation and then amplifying that with tariffs, then that could be really bad for markets, because then consumers are really constrained. So if consumers are being stimulated with an easing Fed policy, then that could be the cushion that we need for markets to help absorb the potential shocks from new tariffs. creates this tailwind for the market is what we call it.
Oh, right. And as a reminder for our listeners, tailwinds help increase growth or cause positive effects on profits and revenue, which is obviously good for the stock market. So, okay, so the Fed is giving the market a safety net, kind of, right?
Exactly. But the key is to make sure that that's still maintained. So we have to watch the data. So the key is maintaining this easing cycle to avoid the volatility that we saw in 2018. It's a delicate balance. Everything's a balance, I feel like.
Yeah, a balancing act. And when Jess says easing cycle, more jargon, she's talking about monetary policy, which is a money policy, kind of like tool that the Fed uses. But as a refresher for what we're discussing today, the U.S. Federal Reserve, aka the Fed, for example, reduce interest rates and increase the money supply. Right? Did I miss anything?
Yeah, that's a piece of it. And then easing is they're just loosening credit policy. So they're making it easier to access cash. A part of that is with their balance sheet, which is QT and QE. And then another part of that is with the interest rate policy. And right now we're focusing on the interest rate policy. We want to make sure that they keep lowering rates. We do not want them to raise them.
Okay. That's in the name. They're easing, making things easier for us.
It is
loosening the jar for us. So it's easy for us to unscrew it.
Yeah, exactly.
And okay, so Papa Powell turned from what we call hawkish Fed to a dovish Fed. Did that happen as soon as he lowered the federal funds rate or the interest rates the first time last September? Like, when does that shift from hawk to dove happen for the Fed?
Oh, I really like that question. It's in a couple of ways. In a literal sense, so hawk means raising rates. You know how hawks are like looking from above and staring down, and then doves fly low and they're kind of soft and delicate. That's where that comes from. So definitely in the name. You can be a hawk due to your interest rate policy stance, which means prior to taking action, and also the words that you utilize. So we said that Papa Powell was actually turning dovish when he said it's time to put interest rate cuts on the table, which happened prior to September, which is when we had those episodes that said, yo, we should think about locking in our rates because Powell is thinking about lowering them. That's where that was triggered and came from.
That's right. And if you've noticed your HYSA interest rates going down, that was why we informed you.
That we did.
We told you what to do. We have episodes on CD ladders and bonds and all kinds of things you can do to lock in your money for a higher interest rate if they're still available. So I wonder if tariffs could actually work in the market's favor this time. I guess we'll have to watch and see how this unfolds, and this season of the United States of America should be interesting.
Yeah, I do think it's the biggest headwind within the market because we don't know what's going to happen. And the one thing the market does not like is uncertainty. At the end of the year, the Fed introduced uncertainty around fiscal policy with their SEP, the series of economic projections, or the dot plot, which means they are unsure about where monetary policy is going to head due to fiscal policy, which tariffs is fiscal policy. So we shall see.
And if a tailwind is good for the stock market, that means a headwind could be bad, right?
Yeah, like literally from a plane, you know, and you fly like in the jet stream. And then if you were going against it, that would be really bad. It's just like that. Everything's in the name. No one's creative. And I'm glad.
Easier for us to remember.
All right. Well, speaking of tailwinds, let's talk about a tailwind for capital expenditures or CapEx, which is deregulation. And this is a theme that has to do with fiscal policy that could create some fertile ground for businesses to invest in that modernization and efficiency, or invest in general.
By deregulation, do you mean rolling back rules for companies? Because that sounds like it could be risky.
Well, it can be. It can be a lot of different things. So we may have somebody else in charge of the FTC, someone else in charge of the DOJ. So if we have an environment that's more conducive to capitalist society, that's going to be great for the stock market because they're not splitting up Google for doing all these things. Google can now invest and grow. And there is definitely a balance between that. But in this case, it could be strategic. Deregulation, it reduces friction, especially in industries like technology and AI. If they get too big, then that's when the splitting up happens. And if they're splitting up, then businesses have to readjust, and that could be costly. So if they're not splitting up and they can spend more on growth rather than the compliance end, that tends to be a tailwind for the stock market.
It could also mean things like job losses or monopolies, which usually means even higher prices for consumers, to name a few things. So I guess we'll see what happens and how it affects us, but I'm going to be positive and hopeful that it's good for technology and advancing us and, not the bad things that can happen to us workers and consumers. So we'll stay positive for this. I'm wondering how this deregulation connects to the AI boom you mentioned earlier.
So it's a good connection, and you're right. There is such a fine balance. Regulation is there because people tend to abuse power.
Yeah.
So we want an environment that is going to be good for that, but enough where you can innovate, but people also don't do stupid things.
Yeah.
But nonetheless, deregulation aligns really well with AI-driven capital expenditures. Companies are uncertain with what's going to happen with policy. When the election outcome came, uncertainty was removed from the market purely because uncertainty was removed. We would have a rally because now we understand what we're going to have to do with our investments, right? And this is from a company perspective, not just consumers. So companies are pouring, we know they are because they told us on their earnings, resources into AI infrastructure. And if you add that with fewer regulatory hurdles, then the US can maintain a competitive edge in global technology markets. They can invest more, thus innovate more.
Okay, got it. So it's about positioning the US as a global leader in innovation, and especially with AI, I assume, because, I see lots of AI robot reels, having kind of scary capabilities in Asian countries already. But anyway, I think this sort of deregulation is aiming at striking a balance between, I guess, innovation and oversight.
Yeah, it is. Exactly. It's the theme to watch if you're invested in the tech-heavy sectors, which honestly we all are. If you're in a passive fund, it's about 30% of the market.
All right. And to break this topic down just a little bit further, going back to the idea that deregulation would help businesses invest in, quote, modernization and efficiency, I feel like this is about a term we haven't really talked about yet that you mentioned earlier called capital expenditure, aka CapEx, right? Have we talked about that? I don't think we have.
We have, but not directly. We've talked about it indirectly. So all I mean is companies are ready to invest and are willing and able to. They're going to spend money. And if there's money on the sidelines waiting for certainty, which the interest rate environment was a piece of certainty, the fiscal environment is a piece of uncertainty that's going to get more certain as time goes on. They're waiting to spend. And so they're going to increase a CapEx cycle. And if companies spend money, someone will be benefiting from that. And we're trying to figure out who that will be on this whole AI revolution.
Yeah.
And
just for listeners, examples of CapEx include the purchase of land, vehicles, buildings, heavy machinery, things like that, which is different from operating expenses, aka OpEx, which are costs that are supposed to provide benefits like in a 12-month time frame. Whereas CapEx expenses are more of an investment in the company's future. So this is my question. Is this deregulation supposed to help companies have less oversight from like their board or shareholders when it comes to how they spend CapEx? Or does it have something to do at a federal level, like the deregulation part?
It's regulation on a federal level because that's what would be implemented is on the fiscal policy side.
Okay.
So think things like splitting up less companies, rolling back certain acts like the mandatory audit systems and things like that. That's costly. You don't have to spend money on your mandatory audit. You're going to spend it on innovating.
Okay, that makes sense now.
There is rules and regulations for a reason and all about it. But too much can also hinder things like, not being able to talk about finance on social media.
Right.
But I digress. The next innovation that I believe we'll see is within AI agents, where and we should have an episode on our next investment thesis because we've been covering AI extensively.
Yes. I would love to have a 2025 investment thesis episode.
Yes. So this is investment themes, and then maybe we'll just narrow it down to investment thesis around it.
Yeah, for sure. Okay. Last but not least, retail trading. First of all, let's define what retail trading is. Jess, would you like to?
This podcast covers retail trading. That is do-it-yourself, self-directed investors. That's it. We call it on finance media retail. Retail and institutional. Those are the two.
Yeah, so there's retail investors and institutional investors. And basically all of you listening, for the most part, I'm sure are retail traders. Unless you're, investing for a bunch of people at a big company.
Okay. A hedge fund or something. Yeah.
Yeah. So what's new with retail trading in 2025?
So accessibility. And this is so interesting. This is where we kind of translates over to my day job. So for my day job, I talk to all the retail trading brokerage firms and they tell me all of their new tools and features. And I really keep up with what's happening on the retail space. And brokerage firms are now more on a mass level rolling out 24-hour stock trading. And you might have gotten notifications of that. Certain brokerage firms are, but it's this common thought process where some people say, oh, well, the retail trader wants to be up in the middle of the night and are just trading 24 hours. No, it's actually allowing global investors to trade U.S. markets during their normal hours.
Oh, yeah. And I mean, this is great news for a night owl like me, because I am one of those night owl people who never thinks to look at my portfolio or take any action until after 5 p.m. So just for context, the regular USA stock market hours have always been Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Standard Time. So that means are there any opening and closing hours anymore? Is the stock market just open 24/7 now for any kinds of trades?
Oh, that's such a good question. So there's actually extended hours now. They're just not forever long. So there's the regular market session, there's a pre-market session, and there's a post-market session, but they act very differently. Normally, it's just stocks that are highly liquid, so have a lot of volume, and some ETFs. So you could actually trade as early as 5 a.m. and then as late as 8 p.m. That you could do with stocks already. But that's still not enough for our friends over at APAC and the other side of the world trying to trade. So it's going to be more of just an extended session. And it's a little bit of a different market. You'll still see the market close at 4 p.m. There's just this after hours session that will occur. And that after hours session will be very, very long. Kind of like the futures market. Futures trade 24/7.
Oh, I didn't realize that because we haven't talked about futures market yet.
Yeah. But what I think will come next, so this is just a market mechanics piece, is options trading. Because if you want to have proper 24-hour trading, you need to have a market. A market needs to exist, meaning there needs to be buyers and sellers. And then if you're going to have market makers take the other side of that, the way that they can properly hedge their portfolio is with options trading, which means options has to come next. But since there's more participation, there's more liquidity, there's more incentive and more reason to properly do that, which means hedging from the market maker side.
But who's up at 3 a.m. trading options then? Is it hedge funders or can anyone
that's
do it?
No, so that's not available just yet.
Okay.
It's definitely going to be for market makers and the market mechanics behind that. But options are a tool for understanding market direction. It's not something that is for everyone at all because they're complex. However, it's an indicator and something that I use to understand what's happening with the markets. But it's more for positioning, hedging opportunities. Even from a retail investor side, if you do avidly trade options, there's an expiration period on Fridays, which means you're not hedged until Monday. But the normal person isn't going to beta weight and delta hedge their entire portfolio.
Okay.
Which is a mouthful that I just said there.
Well, and also, we haven't really talked about options trading yet, and I'm sure we will, hopefully this year. But there's different order types you can use when buying stocks, on, a regular trade. So do order types not work the same for options, or is this a way for people who do options to react to overnight news events that happen, something big happens somewhere and they can react in that way? Is that the benefit?
It's more for the market maker side because they're providing liquidity, right? So now we've got this expanded trading. There's a ton of them during the regular market sessions. We want them to participate now in these extended hour sessions. In order to properly do that, they need an options trade, because that's the only way they can hedge, as in protect against a downturn. Remember when we did the episode on how market makers work? They keep a delta neutral portfolio. Wow, we got advanced real quick, which means that it basically means that if the market moves, it doesn't affect them whatsoever. And they can do that because of the way that they make money. And you want them to. They make money off of an amount of orders, not stock direction. But the way to properly flatten out or reduce or smooth out the volatility is with options, which can be such a complex process. I am happy to explain it to anyone who would love to, but it's more of an institutional side. It is a way to de-risk and hedge overnight because they are taking on billions of dollars from that market maker perspective.
Right. Mm-hmm. So, okay, I can see how this helps institutional traders or like hedge fund managers, but is this a game changer for retail traders at all?
It is, because innovations like this, it's still democratizing market access and it's driving broader participation. And in this case, it's really making our markets more globally accessible.
Yes. We do want everyone to participate and to see more barriers to entry into the investing world broken. Because you know what I always say, if it ain't broke, break it. Right? And what about, are there any good publicly traded companies we can look at in regard to this new development?
So I have two theses with this. And again, do your own investing homework. But one, we've seen this investing thesis of upgraded or additional market access, I think has a lot to do with Bitcoin. We don't talk about Bitcoin, but meaning this supports it. Bitcoin's had a big rush up.
Yeah.
Because if you're a foreign investor, you can deposit Bitcoin into your account to access markets, which is so much easier than a US bank account. I think that's an interesting thing. I'm not saying buy Bitcoin, but I think that has to do with the run up of it is global market access.
Okay.
Which kind of makes sense, right? Because you're buying more Bitcoin to access US markets because you can instantly transfer.
Right.
Whereas you wouldn't be able to, you're a foreigner. And then you can just watch companies that have access to this. You got to remember, one, it's the exchanges. So like CME Group, if they're involved in expanding the 24-hour trading capabilities, if brokerage firms like Robinhood, Fidelity's Not Public, or Schwab, or things like that start expanding it, well, they're going to have access to more transaction fees, because options, you still get transaction fees. There is still payment for order flow on the back end. We talked about that, but that's a way that they make money. And so those are ways that you could potentially capitalize on this increased trading.
I see. I haven't even heard of CME Group, so I will be adding that to my homework list, because Jess might be my teacher, but I'm the one giving myself my own homework here. Or maybe we should start giving homework on the show to make sure we're all learning along the way. Or maybe the homework is for the investing courses that we're working on. Little teaser. Okay, so maybe also this is the year where you finally teach us about options trading, because I know a lot of your fans on TikTok have been asking about that in the comments, and I've seen some on our YouTube comments. So I think I might actually be ready to at least learn about it foundationally, if our listeners are.
I think we can. It's just options are complex. They're not for everyone. I want to make sure we set a solid foundation first, but we could sprinkle it in if you'd like.
You always do. You set the foundation. It's because we're, building knowledge here, right?
And breaking barriers. That's right. It's not the end. So.
That's right. Always more knowledge to build.
That's so true. So 2025 is definitely shaping up, or the theme so far seems to be the year of investment, infrastructure, and innovation, from private corporations modernizing infrastructure to new trading capabilities for retail investors, even more expanding on AI with AI agents. That revolution is there, but these themes are definitely transforming the market landscape, something to watch. Things can change, but this is the thought thus far.
And what would be the key takeaway for our listeners today?
Stay informed and adaptable, of course, because certain headwinds could emerge that we didn't know were there. These themes are certainly opportunities that you could see within the market to position yourself for the future, but you also need to take the appropriate steps if you're going to take action on them, which we haven't done today. We're just talked about them.
Yeah. Yeah, I definitely think we should do another investment thesis episode for 2025. But if you are as intrigued as I am, let us know which theme excites or scares you the most for 2025. Hit us up on social, and if you're new here, you can find all of our links to all of the things in the show notes below the episode description.
Thanks for joining us on Market MakeHer. Don't forget to subscribe and leave a rating or review to tell us how you really feel. Stay curious, stay empowered, and keep making your mark on the market.
And remember, when you build knowledge,
you break barriers.
That's right.
Remember, investing involves risk. There is always potential to lose money when investing in securities. Market MakeHer provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market MakeHer on our website or podcast is not intended to be a substitute for professional financial advice. Market MakeHer is not liable for any investment decisions made based on our content.